Are you someone who thinks that the top 5 banks in Canada are working in your interest? Today, I'm going to talk about mortgage secrets that these banks do not want you to know and how they might be siphoning thousands of dollars in your mortgage. So, let's get started. If you are new to this channel, my name is Navjot and I'm on a mission to retire 1 million immigrants with $5 million. And if you want to join this mission, all you need to do is subscribe to the channel. Going on to the video today, mortgage secrets that banks don't want you to know. First, we'll talk about the basics. We'll understand the difference between banks, monolines and B-lenders. Then we'll talk about the comparisons of rates and penalties and how banks might not be the best option depending on who you are. And finally, we'll be talking about the lowest rate when you are getting your mortgage and the hidden scary clauses that you need to watch out for if you are taking a mortgage this year. Now let's understand the basics of, we have banks and you all know these banks: CIBC, RBC, TD, BMO, Scotia. And guys, I'll not be taking a lot of specific names on banks and clauses. And I'm sorry about that because I'm a mortgage agent. I'm not supposed to take names and put definite clauses. So I have to respect the confidentiality of my license as well. And that's why I'll not be making very specific, but you will get a general idea of everything that I'm talking about. Talking about monolines are not really B lenders. I think that's a massive misconception that people have. Monolines are actually like banks. There are, banks like First National, RMG, MCAP. I don't know if a lot of you have, learned about these, but they're not really B lenders. In fact, their mortgage rates are almost the same. The only difference is that they are not top 5. They don't have any branches. They don't have any physical locations. And in fact, that's all the more reason they are able to give a much better terms. And we'll talk about that in a bit. But they are definitely not B lenders with high interest and fees attached to it. In fact, First National is a listed company on the stock exchange, and First National actually gets its money from TD. Same way RMG and MCAP also get their money from big banks like RBC and BMO. And finally, we have B lenders that have 1% lender fee attached to it. We'll talk about the flexibility that they allow, but obviously the rates are a lot higher. Now, these banks also are some, like EQ Bank is something that a lot of you have heard about. We actually keep our high interest savings account there. Home Trust, Avio, all these, companies are B lenders. Avio is someone that I have my current mortgage with because I need the flexibility as I'm a self-employed person, and therefore the banks and the monolines do not, give that flexibility away. Now, what I'll be doing is I'll be comparing them against these 7 parameters: rates, fees attached to it, penalties, portability, line of credit, service, and flexibility. And I'll be explaining all these terms as we go along. Let's talk about the rates first. Obviously, the banks have the best rates in the market, so they get a 5-star rating there. Monolines have slightly higher rate, and I'll talk about that in my next section where we compare these lenders on rates and penalties. They have slightly higher rates, but they have other benefits of flexibility and lower penalties, and we'll talk about that in a bit. Just to give a comparison, the monolines will be about 0.2 to 0.25% more expensive on rates. However, that's only fixed rates. However, on variable rates, most times the monolines will actually be a lot cheaper than even the banks. That's the reason why I've given them a 4.5 rating. And B lenders obviously have almost 0.7 to 1 or 1.5% higher interest rates. I've given them a 3-star rating. They're not the worst. They are really good for people who require the flexibility, people on contract jobs, people who are self-employed, people who are newly self-employed, just like myself. I have 3 years of, self-employment. However, my income, the personal income that I show is very less, and therefore I require the flexibility for the lenders to look at my business income as well to qualify me for a mortgage. And I have just given them a 3-star rating because the flexibility comes with more expenses. Then you have the fees, which actually the banks do not have any fees. Same with monolines, and that's another misconception. Just because we have not heard a lot about these names, these don't have any branches, we just assume that they are B lenders and they have fees attached to it. However, B lenders do have a fee attached, which is usually 1% of the mortgage amount that you are taking, and I've given them a 3-star. And yes, I have given them a 3-star and not a 1-star because there are private mortgages that can charge up to 3-4% depending on your mortgage, where you are buying and how stuck you are. And those are the lenders that I'll generally give 1-star rating or 0-star rating to, and not my favorite mortgage to do. Private mortgages are brutal, but yeah, B lenders are really a good option for people who are looking for flexibility, and you just need to give more interest and fees attached to it. In terms of penalties, banks have in fact the worst way of calculating penalties. Most times they actually don't really calculate the penalties on your interest rate that you got. they actually have a different posted rate on their website and they calculate the penalties of that rate. And there are certain banks who would calculate penalties not on your mortgage amount but on a percentage which is usually higher than your purchase price, and that can actually lead to thousands of dollars of more penalties. I will be putting numbers to that in the next slide. And therefore, if you are someone who is planning to upgrade a home or break this mortgage in the next 3-4 years, or for any reason you want a lower interest rate and therefore you're moving to another lender, banks are probably not the best option for you. Whereas monolines actually calculate penalties on their rate that they have given to you, and that actually amounts to a lot less. In some cases, the penalties can be as low as 1/3 of what a similar bank would charge. And that's why monolines actually become one of my favorite options when it comes to penalties. And B lenders again are not very flexible when it comes to penalties. They also have pretty high penalties. It's very equivalent to banks. I'll not put them under banks. They are very equivalent to banks when it comes to penalties. Portability is a clause which is really important if you are someone who is planning to upgrade a home, because portability allows you to take your existing mortgage. Let's say you have a low rate on your existing mortgage. You can actually take that rate with the mortgage that you have and add it to the additional mortgage that you are getting on the new home. So you're actually porting the same mortgage that you have into a new home and just getting the mortgage for the remainder of the amount if you need that additional amount, and you're just blending that rate and the mortgage amount into your existing mortgage. So that portability clause is really important, and that's something that banks and the monolines actually provide. In fact, even B lenders, most of them have the portability clause, but it might come with a reinvestment fee which can cost you about $1,000 to $2,000 depending on the B lender that you're working with. But again, portability is something that my clients always get, whether they're going for B lenders or banks. Now, line of credits is something that the banks beat everyone else over. If you are someone who is doing over 20% of down payment, you can start with a $0 line of credit, and that increases every time you pay down the mortgage principal. That's something that is only available with the banks, whereas the monolines and the B lenders, most of them do not have that facility. However, if you are someone who is doing a less than 20% down payment, this point actually doesn't hold true for you because you're not eligible for a line of credit yet. And therefore, basing your mortgage decision based on availability of line of credit may not be the best option for anyone who's doing less than 20% down payment, because you right now are not eligible for this. The sixth point is service and banks. And I'm pretty sure that you have this experience. When you call them, they go to an IVR, they don't pick up the call. Most of the times, the staff is not very well trained, and there are all sorts of problems, and it's a touch and go whether you'll get the answer or not. At least I have had this particular concern with three of the top 5 banks that I bank with. Scotiabank is probably by far the best, and I said that I'll not take names, but I'm just talking as a retail banking customer, that Scotiabank is probably the best bank when it comes to the education levels at the branches. Just biased towards Scotiabank a little bit. Monolines actually do not have that problem. First of all, they have an excellent online portal which allows you to do everything related to your mortgage. In fact, make additional payments to your mortgage through the online portal. Even if you have to call them for anything, let's say you want to port your mortgage and you need to call them and ask for the process, because they only do mortgages, first of all, they'll pick your call pretty quickly, and second of all, they'll actually be able to answer your questions very well because the staff is trained to do only mortgages. And therefore, I absolutely love working with monolines purely because their servicing is top notch. B lenders are also very decent when it comes to servicing. I've just taken a star off because I just love monolines and their servicing. B lenders can be a little bit complicated depending on the bank that you work with. However, they are pretty good with servicing, way better than banks, because they are also someone who is only doing mortgages, and therefore they have to be trained enough to answer your questions. Then talking about flexibility, the banks and the monolines do not actually offer a lot of flexibility. When I say flexibility, yes, you can do a less than 20% down, but for instance, let's say you are in a new business and you require a mortgage at less than 20% down payment, or even with 20% down payment, just because you don't have 2 years of tax filed for your business, or if you're not taking enough of personal income, they will not lend you money. And that's where the B lenders come in handy, where they are a little bit strict on certain cases. However, in most cases, as long as you have 1 year of bank statements available and you are making enough money, and let's say you have one tax filing in your in your business, you will be getting a mortgage. So I love B lenders for anyone who who is maxed out on their eligibility on the number of homes that they can buy with a bank, or for anyone who requires extended ratios because your income that you show personally is a lot lower purely because you run a business. Now, obviously, you might think that Navjot is biased towards monolines. Probably they are getting, paying us more than what the banks are. That's absolutely not true. In fact, some of the banks actually pay us more in bonuses. And I just feel that monolines is way better as an option for anyone who is doing a less than 20% down payment. But if you are buying a rental property or if you're doing more than 20% down payment, most of my clients actually go to the top 5 banks. Now, there are certain cases where I do put people with less than 20% down into the top 5 banks as well, and most of those cases are where the interest rate is way lower than the difference in penalties. Or if you're someone who is not planning to break your mortgage in the next 3 to 5 years, and then maybe the banks could be an option that we go for. However, a lot of the times monolines do make sense for a lot of people. In fact, I want to prove that to you with numbers. Now, this is a sheet and it looks like very complicated sheet. I have different columns as well, but let's understand what this sheet actually says. This is basically, I'm comparing different lenders. I'll not take any names because as much as I want to, I cannot, I think, take names here, but I'll just be safe there. The price of the house is $800,000. Let's assume that's the case. You are doing a 10% down payment, which is 10%. Down payment is $80,000. You have to pay a mortgage insurance, which is $22,000 because you're doing a less than 20% down. Therefore, you need to pay mortgage insurance, which is more popularly called CMHC insurance. Total base mortgage becomes $742,000. The posted rate of interest, and I talked about the posted rate a little bit, earlier as well. Now, let's say you get a 4.7% rate for the 3-year mortgage that you are taking, 25-year amortization. However, your posted rate is 6.74, and that's something that you can get on the bank's website. And this, I actually have taken these rates from the bank's website. What this means is that if they were not giving any discount or anything, their rate will be 6.74%. And that becomes really important when you are calculating penalties, and I'll get to that in a bit. Your negotiated rate, or the rate that you actually get, is, let's say, 4.7%. Now, don't go by the rates that are written here. Depending on when you're watching this video and when I made this video, these rates can be very, very different. Some people get lower rate, some people get higher rate. It depends on your profile as well. But just look at the differences, yeah? The amortization is 25 years because you're doing a 10% down payment. The mortgage payment becomes $4,200. Forget the monthly difference for now. Now, let's say you are breaking your mortgage in 2 years and your outstanding balance, which started at $742,000 at the start of the term, in 2 years, it's down to, let's say, $709,000 and change. And the projected rate, let's say when you're breaking your mortgage, is 4%. The way penalties will be calculated is they'll subtract 6.74 and 4%. So 6.74 was the posted rate when you took the mortgage. They are not taking 4.7, they're actually taking 6.74 minus 4%, that is 2.74%, and they multiply it by your original mortgage amount. And that comes to about $20,000 per year. This is per year. If you break your mortgage in 1 year, you actually pay double the penalties. So this is the penalty that you will pay for breaking your mortgage 12 months early, and that is massive. And that's how most big banks actually calculate the penalties on. Now, let's compare this particular bank with bank number 2, 3, and 4. And the reason why I have clubbed them all together is because they are very, very similar. Again, I'll not take names here. There is a 5th bank, which is very different, and I'll talk about that in a bit. Let's say everything else remains the same. Their posted rate is almost the same. The negotiated rate is slightly higher. And the reason why they give a slightly higher rate is because they are also giving cash back, which is upfront, about $3,000 on this particular mortgage. The monthly payments will be about $43 of difference. In 2 years, you'll save or you'll spend about $1,000 more in monthly payments, but you are getting $3,000 of cash back. So it's worth, looking at it. The outstanding balance in 2 years will be slightly higher, $710,000, hardly makes a difference. Let's say the projected rate is about 4%. They will also calculate the penalties just like the big bank one, just how they calculated it, and your penalties will be very similar at 20,000. So the only difference between these two, options is that you are getting slightly worse rate in the second case, but you're also getting cash back, which, by the way, is clawable. What I mean by clawback is that if you break your mortgage in between the terms, they will prorate the cash back. If you break your mortgage, let's say halfway through, they will claw back $1,500 of the $3,000 that they gave you. Now, prepayment privileges are the same. They allow you to prepay 15% of your mortgage every single year. They do provide HELOCs, so all banks provide HELOCs if you have more than 20% 70% equity in the home. They do provide the option of refinancing. They do provide the option of portability that we talked about in the previous presentation. Let's compare this particular case with bank number 5, and everything again remains the same. They have a slightly higher posted rate. They have a much lower interest rate, which leads to $1,000 less payment across 2 years. You save about $42, and this difference is from bank 1. So I've just done the differential from bank 1. If you look at these two, there will be a difference of almost $85 between the payments, as you can see here. The penalties are, you will see, are a lot higher, and the reason why the penalties are a lot higher is that this particular bank actually calculates the penalty on the differential 6.89 minus 4%. First of all, their posted rate is slightly higher, but that's not what is causing the penalties to be a lot higher. What's causing the penalties to be a lot higher is that they are actually multiplying it not with your the mortgage that you started with, but they are multiplying it by 125% of the purchase price. So you're actually paying the mortgage, the differential, on a much higher scale, and that is what is pushing the penalties by almost $8,000 to $9,000. And imagine this is only for 1 year. If you break your mortgage 2 years early, and if you are with this particular bank on a 5-year mortgage, don't even think of breaking your mortgage, because you'll be paying thousands of dollars in penalties. The highest that I have seen is $62,000. So hold on if you are with this particular bank. I'm again sorry, I can't take this name. The other difference with this particular bank is obviously they are giving the cashback and all the facilities are there, but the prepayment privileges that you have, which is how much can you prepay your mortgage every single year, is 10%. I don't think it's a game changer. Most people don't do that much even. But if you are someone who wants to prepay your mortgage very aggressively, this bank may not be the best bank for you. Now what I'm going to do is I'm going to compare this with a monoline, let's say First National or an RMG. I'm again not taking specific names here, but both of them are pretty similar. I would say the price of the house is $800,000. The down payment is 10%. 80,000 is everything remains the same. But the difference is the posted rate is equal to the negotiated rate. So the rate that you get, yes, it's a little bit higher. It's not very high from this particular bank, but it is slightly higher, but your posted rate is also equal to the negotiated rate that we have. The payments will be about $60 more than bank 1 and about $100 more than the best option here, which is big bank number 5. However, the penalties are a lot less, because the way they calculate penalty is, first of all, they are subtracting 4.84% from 4. The rate that you got minus the 4%, the rate that at the time of breaking the mortgage. So that is 0.84% multiplied by the balance outstanding after 2 years. So they are not even taking the total mortgage balance, or like the big bank 5, not taking 125% of price of the house. No crazy numbers here. The penalty is legit $6,000, which is a third of any other bank. And if you compare with this bank, it's not even comparable. So yes, you are paying about $1,400 to $1,500 more in payments for the 2 years that you kept the mortgage for. Yes, you are also not getting any cash back with this particular option, but you are potentially saving almost $14,000 to $15,000 of penalties per year that you break your mortgage early. Now, I know that I've always talked about 3-year mortgages being the best mortgage for most people right now. However, let's compare the 4-year mortgage for monolines and compare everything against all these options. The rate actually slashes down to the lowest in the market right now. If you compare any of these banks, you will always find that the 4-year rate is lower for any bank, and especially for monolines, it's actually under 4.7%. In fact, we just got someone a mortgage for 4.59% just last week. So the 4-year rate is actually pretty low when it comes to monolines. The mortgage payments will be slightly lower than the bank 1, but a lot lower than a lot of these options. You are not really saving a lot on interest rate, but it is now very comparable to other banks if you compare the 4-year with the 3-year. However, if you look at the penalties, let's say you again break your mortgage in 2 years and you pay the penalties for 2 of the remainder years, the penalties will still be a lot lower compared to any of these banks. So yes, you are taking a 4-year mortgage and not a 3-year mortgage, but if you calculate the numbers, you are getting the advantage of a comparable interest rate. So not only are you getting a lower interest rate, you're also saving on penalties despite taking a 4-year fixed versus a 3-year from a big bank. So in my view, for first-time home buyers, I think 4-year mortgage could be the sweet spot if you are looking for the lowest interest rate. At the same time, you want to save the penalties that the big bank actually puts if you break your mortgage early. Now, we do these calculations for every single client of ours, and we decide on the lender based on numbers and not just the emotion of working with the top 5 bank, because at the end of the day, we are looking for the lowest interest rate with the best terms and the lowest prepayment penalties, because you like it or not, most first time home buyers do break a mortgage in less than 3 years. And if you are someone who does that, the penalties can be absolutely brutal, and that would allow you to not upgrade your home or break your mortgage, and that flexibility will be taken away from you. Apart from this, we also need to look at 3 or 4 very critical clauses, and I'll talk about that one by one. These are some of the things that a lot of the professionals in the industry don't really understand, and a lot of the discount mortgages that you see, the lowest rate that you see in the market, I'll not take names again, but some of them actually come with some of these clauses which are pretty scary. What I'm trying to say here is the lowest rate is not always the best rate, and there's a difference between lowest and best. Let me talk about the scary clause number 1. Now, there are certain mortgages that do not do rental properties, and therefore they have a clause called occupation by borrower. What they mean by this clause is that if you are buying for yourself, you can never put your home on a rent. Let's take my example, right? So in my first home that we bought, a condo, we lived in it for about 1 year and then we put it on rent. Now, if we were with one of the discount lenders for the lowest interest rate, we would not be able to do that. And the only way to do it is to break the mortgage, pay the penalty, and move to a bank which would allow us to make it a rental. This particular clause is especially extremely important for someone who is looking to house hack, turn the entire unit by living in it, for 1 year, and turn the entire unit into a rental later, and then upgrade to a bigger house. If you are someone like that, be very wary of the lowest rate in the market, and be extremely wary of the occupation by borrower clause. The second scary clause is bona fide sales clause, and this particular clause says that if your mortgage contains a bona fide sales clause, it means you cannot pay out or break your mortgage before the end of your term unless you sell your house. So the only way to break this particular mortgage is to sell your house. If you want a lower rate in the market, if you want to do anything else with your mortgage, if you want to refinance the mortgage, there is a very high chance that if you have this clause, you'll not be allowed to do that, and the only way to break the mortgage is to sell your home. If you see these 4 words in your mortgage statement, run away as fast as possible. The third scary clause is something called as a reinvestment fee, which is a charge to recoup the costs associated with originating your mortgage. Now, all banks actually charge this reinvestment fees, and they range from about $300 to $700 depending on how large your mortgage is. But there are certain lenders who would put a 3%, 2%, 1% of your outstanding balance as fees, and this is on top of the penalties that you any which ways will be paying, irrespective of the bank that you're working with. This is something that you should definitely look at when you're signing your mortgage documents, and you need to make sure that your reinvestment fee is under $1,000, which a lot of banks would charge as an admin fee, but it should not be a percentage of your outstanding balance. That would be brutal. And the fourth and the last scary clause will be non-portable mortgage, which basically means that you cannot take your mortgage to another house if you are upgrading your house, and that can particularly cost you thousands of dollars, especially if you went into an insured mortgage. Let me explain this. Let's say you take out a $500,000 mortgage and you pay just 5% down payment, and you are paying a CMHC mortgage insurance of almost $19,000 or $20,000 on this particular mortgage. Let's say 3 years, 4 years down the line, you sell the home for $600,000, and now you want to buy a $900,000 home with a 10% down payment. If you do not have a portability clause in your mortgage, you will not be able to port the mortgage that you have into the new home. In fact, you will have to break this mortgage, pay the penalties on this one, and then buy a new mortgage insurance for this particular mortgage. If you had the portability clause, you would have not paid the new mortgage insurance. You would have just paid the difference there. This can actually cost you almost $24,000 to $25,000 of mortgage insurance, plus the $10,000 to $15,000 penalty that you pay, and overall $40,000 to $50,000 of additional fees that you will be paying unnecessarily just because you do not have a portability clause in your mortgage. Now, these are just 4 of the many clauses that you need to stay away from, and that's the reason why I say that the lowest rate is not always the best rate. And the top 5 banks are in it to make money, and if they are charging you a lower interest rate, there is something else that they are doing, and in most cases, they are charging you a much higher penalty if you break a mortgage. If you like this video, do share it with a friend. मिलते हैं अगली वीडियो में, तब तक के लिए बाय बाय।